I've been trading for 6 years and I was unprofitable for 3 of them. But it doesn't have to take you this long. You see, during these 3 years, I made a lot of mistakes. But now, after 6 years in the market, I've been able to make multiple 6 figures and get results like this, and this. And so in this video, I'm going to tell you what took me 6 years to realize, from unprofitable to profitable, explained simply enough that even a beginner can follow along. And let's start with simplicity. When I started off trading, I started with trading 28 pairs. Then I moved into 9, and then I moved into 2, but on the seconds charts. And now I only trade 1. And I don't say this because you have to trade 1 pair. It depends on the market that you are trading. But I say this because simplicity is key. And this is one of the big things that I've understood. When I was starting to become profitable, I was looking at 50 different things at the same time. I had Fibonacci retracements, I had candlesticks, I had manipulation, I had supply demand, so many things at the same time, and I had no idea what to focus on. And now I focus on 3. The direction of the market, the structure of the market, and the liquidity that the market is targeting. And ever since I started going into the simplicity of focusing on as little things as possible, my profitability went through the roof. Why? Because now I have a repeatable process. I'm looking at the same things every single day. And I know that a lot of traders are doing the opposite. They're looking at so many things. They're looking at indicators, they're looking at price action, they're looking at trend lines, they're looking at market structure. You don't have something reliable to focus on. And this is why I like to strip trading down to the basics of, first, you need to know where the market is going. This is where direction comes in, and I think direction is the most important thing that every single trader should focus on. Then we have market structure, which will help you with trading direction and with your executions. And then you have liquidity that helps you with manipulation, and it's going to help you with targets, because you want to enter after liquidity has been swept and you want to target after liquidity is taken out. But I know that maybe you might be thinking, well, this is too simple. I don't get it. Trading is not supposed to be simple. And I thought the same, but I came to the conclusion after 6 years of trading that from every single very profitable trader that I know, they could write their strategy down on a napkin. Not only that, they could explain to me why that strategy works on a napkin. That's how simple they keep it. And that's how I understood that if I simplify everything down to the basics of direction, structure, and liquidity, then I can actually become profitable. And I now understood trading does not have to be hard. Everyone on social media makes it look hard or makes it sound hard. Why? Because it gets you in the loop of watching their stuff over and over and over again. And that is simplicity on the strategy side. But let me simplify trading statistics to you. You need to focus on 3. Trade frequency, which is the least important, strike rate, and risk to reward. And I might say, well, Kemal, why is that? It's because your strategy will have a balance of strike rate and risk to reward. How many times have you seen those traders with the 1 to 10, 1 to 30, 1 to 40 risk to reward? And you think, how the hell are they able to do this every single day? Here's the key. They can't. They only show you the winning trades. They don't show you all of the thousands of losing trades that they take. And I've understood from talking so many traders that have a high strike rate, they're telling me about their losses, and I'm like, I've never seen any of this online. How come you're telling that to me? And that's because you're seeing their results either in hindsight or they're not even real. So the realistic trading results that you're going to get is always going to be that your expectation of profitability is going to be acceptably profitable. Why is it not going to be exceptionally profitable? Because if it were, let's say you had a 1 to 10 risk to reward with a 90% strike rate and a very high trade frequency, in 1 year you would become a billionaire. Yet there's no one doing that. And the reason I say this is to create the right expectations when we're talking about trading. I want you to understand that if you are going for a low risk to reward, you are very likely going to have a high strike rate. And if you want a high risk to reward, you're very likely going to have a lower strike rate. So you can understand now how this is going to work. And I might say, well, Kemal, I don't think we can control our trading results. Believe me, you can. How can you increase your strike rate? You increase your strike rate by focusing on the trades that are higher probability. But does a high probability trade come every single day? No. So you are reducing your trade frequency. But let's imagine you want a high risk reward. On a high risk reward, you're gonna need at least, let's even say, 500 handles on NASDAQ with a 50 handle stop. How many days have you seen that the market moves 500 handles and you're able to catch the low and exit at the high? Those are very, very rare. So every time that you would target that, you would get a break even or even a loss. Therefore, this balance of risk reward and strike rate is always happening. You can pick one, you cannot pick both. And I call that the trading trifecta. Risk reward, trade frequency, strike rate. You can pick two, you cannot pick all three. The next point is that bigger isn't always better. We're talking about big trades versus consistent trades. We're talking about big payouts versus consistent payouts. Usually one makes sure that the other doesn't happen. It goes back to the strike rate and risk reward. If you want a huge $10,000, $20,000, $50,000 payout, you need to be risking way more, which is going to make sure that you're going to blow way more accounts. Which means while someone gets a $50,000 payout, I might have just gotten $10,000 payouts in that same time period, which means we made the exact same. Yet I had way lower headache because I focused on the consistency and not on the lump sum. Because I've noticed that every single time that I aimed for the lump sum, the stress was immense. We were talking about $5,000 P&L swings over a couple of hours. And I was doing this as I was becoming a profitable trader. And yes, I had very good payouts and amazing trade. But when I look back and I look at my stress levels back then versus my stress levels now, and I'm making as much money as I was back then I know that the headache to reward is way more worth it now. So yeah, I've had massive trades, massive payouts, but just keep in mind that in order for you to make $50,000, you have to be very much willing to risk $10,000, $20,000. And how many of you would have your life already changed with $20,000? Just the proof of concept that trading would give you is already enough for you to not go to those big trades and go for the consistent trades and payouts. Now, this next one is probably the most important thing that I've understood after 6 years. And that is that risk management is the one thing in trading that separates 99% of traders. And I wrote this down, that trading at a point becomes a warfare, and the ones that succeed are the ones that last the longest. Let me ask you this. How many times have you blown an account, be it a personal account or a prop firm account? And how many of those times were you risking 1% and following the plan and not being emotional? Very low. Yet, what if I told you that now you're limited to one trade per day using 1% risk? What do you think the probability is of you blowing that account? Personal, you're not blowing it. Prop firm, you might, but it's going to take you a long time and a lot of bad trades. And the probability of that happening is pretty low if you have a profitable edge. So risk management, once you have a profitable edge, is what glues everything together. And the discipline, which is the most important thing, the discipline to sticking to that risk management and that strategy. And let me tell you, if you don't have discipline, you will not become a profitable trader over the long term. I can already guarantee you that. Because when you deviate from the plan, that's lack of discipline. When you deviate from your risk management, that's lack of discipline. And you have to make sure that you have strict risk parameters that you don't deviate from, because risk management is what is going to make you stand the test of time. If you don't have risk management and you don't have discipline, those two tie in together very well, then it's just a matter of time for you to blow up. And now you might say, well, Kemal, how do I stick to a risk management? Just don't take that next trade. You've taken the loss. Don't take another trade. Leave the computer. Block TradingView. Delete all of the execution apps. Asking how to not over risk in trading is the same thing as, hey, how can I stop eating this? It's like, just don't put it in your mouth. Right? I think it's as simple as that. But this transitions us into a very important part, which is trading psychology. Trading psychology, after 6 years, believe me, and after spending thousands and thousands of dollars in trading psychology courses, I've understood that trading psychology can be boiled down into one formula. Emotion equals reality minus expectation. What that means is that all emotion comes from reality not matching your expectation. For example, you enter in a trade, you have your checklist, you execute. You now expect this trade to be a win. So let's say you expect this trade to be a 2R win. If that trade now becomes a -1, then reality is -1, expectation is +2. You do -1, -2, and it gives you -3R. So not only did you take the loss, but you were also stripped away from the win that you knew you were gonna get. The market owes this win to you. And the way we battle emotions is by reducing expectations as much as possible. So after 6 years, this is what I do. Every single time I enter in a trade, I ask myself, why will this trade lose? I look for all of the reasons why this trade is going to lose. 15-minute manipulation, 5-minute power of 3, market structure is still bearish, order flow is still bearish, there's an order block that the market is going to react from. All of those are reasons as to why my trades are going to be losers. And I make sure to remind myself every single time that a trade can still result in a loss. And like that, I'm always reducing my expectations. And keep in mind, yes, if I take a loss, am I going to be completely neutral? Obviously not. But that doesn't mean that we can't reduce emotions as much as possible. And this takes me to my last thing, which is focus on one strategy, listen to one person that you like, and you'll always land on the most foundational parts of trading. Direction, which everyone needs, market structure, because so many traders short a bullish market or long a bearish market, and liquidity. If you make a strategy around that, which by the way is what Funded Trading Blueprint is, if you want to find out what made me profitable, I do a daily market breakdown every single day. I live stream every single week, and I share my strategy and analysis as in depth as I can inside of Funded Trading Blueprint. It's going to be the second link in the description, but just focus on a few things, the foundational concepts of trading, the foundational things that you need. And those are going to be direction, market structure, and liquidity. And you'll see that if you follow these 6 points, the likelihood of you becoming profitable increases a lot. That being said, hope you all enjoyed. I'll see you in the next one.